GDP got reported yesterday, but yeah,
Okay.
in fact, what really happened, if you take a look at the market, is starting on Monday, people were like, we've had so much selling. Let's do some bargain buying. So there was some bargain buying on Monday, and that led into Tuesday, right? And then Wednesday, there was a combination of, Meta's sour earnings, and also we got some information on Wednesday, durable goods orders. So that was interesting. Let's take a look at durable goods orders. So durable goods orders went up, but then when you look at it minus things like cars and minus things like everything else, but the core capital goods, core capital goods are orders for like furniture, big appliances like washers and dryers and dishwashers. They came in at expectation. So what accounts for this big number in orders that was much higher than expected? We expected 2.3, we got 2.6, even though the prior numbers were revised down. I mean, that's spring orders for new cars, right? That's car sales right there, transportation. So that's interesting that there's this pop up in March for cars. But yeah, I mean, the real news came yesterday with GDP numbers. GDP numbers kind of disappointed, right? And this,
Is that a good or a bad thing? Because I always get confused whether we need that for the market or we want the bad news.
well, it would be ideal if, GDP stayed strong and inflation pulled back. When you have GDP start to pull back and inflation is going strong, right? The opposite, that begins to be, a term that we've heard in the past called stagflation, where you just can't get the inflation to slow down despite everything else. And so people had some worries about that. And I think that's why we saw some sell-offs on Wednesday and Thursday, is that these advanced, now remember, GDP is reported 3 times, right? And it keeps getting revised. And this is just the first pass, but the first pass came in much lower than expected. And then the personal consumption expenditures, which actually gets reported further in detail, and that was reported this morning, we'll talk about that in a second, was still kind of on the higher side. So that means that the Fed might be inclined to not lower interest rates because PCE is still high. And that actually, when we take a look at the actual report just a few minutes ago before we started our show, personal income and expenditures where expected. Personal consumption expenditures, that's higher than expected, right? We expected 0.6. We got 0.8. And then when you start to factor out things, I mean, it came in as expected at 0.3. These numbers, the annual numbers, I don't know if you can trust them yet, right? The annual numbers still have some of the higher numbers. It's hard to get a moving average until they're all within a certain range. But, this was a little bit a tick higher. It all comes down to what the investors, or actually what the Fed does, but also to some degree what investors think is going to happen. So I have to pull back this. So definitely investors are not expecting any rate drop in May, right? That's the next session of the Fed. Last last week we talked about not expecting any rate drop in June either. But now take a look at this. A lot of people are still not expecting a rate drop even over the summer in July. Last week, we thought that there might be the first rate drop in July. Now it tends to be like, hey, we're not even looking until September. In fact, even the September numbers, as you can see here, are under speculation whether they're going to drop. There's still a slim margin that says yes, they will, but there's quite a few people who say they won't. And then you get to November, and by November, people are thinking that there's probably going to be 1/4 point rate drop, and same with December. Basically, in just 5 days' time, with some of the rhetoric from the Fed and some of the stagflation going on, investors have revised yet again. Last week, we saw a revision where investors went from thinking that there was going to be a 3/4 point rate drop over 2024 to only a half point. Now that half point is under, scrutiny, and investors for the most part are thinking that there's only going to be a 1/4 point rate drop, and it'll probably happen in the September, November. So everything's got pushed back. My fear, my personal fear is, Sip, that and this is just my experience of going through the dot-com bust and my experience going through, there was an energy kind of boom bust around 2005, 2006. Then there was the big 2008 housing crisis bust and a couple of little busts since then. My big fear is that the Fed won't act fast enough. And when things start to slow down, they tend to slow down quite quickly. And the Fed, I think, just like they were so slow to react to the increase of stuff, saying that it was temporary, and then it turned out not to be temporary. I'm afraid that the Fed won't react, right? And that they need to be ready to drop rates at a moment's notice. And right now they're a little bit slow, saying they have to look in the rear view mirror and see, check off their check boxes. And I'm afraid that they're going to throw our economy into a little bit of a recession towards the end of this year. We'll see if I'm right. So far, I've been right. I've only been delayed, right? Everything I said would happen has happened about 3 or 4 months after I thought it would happen. So who knows? But I think that, if the Fed's not careful, they're going to throw us into a little bit of a recession.